how might investors or investment strategies be affected when interest rates go up? I think the obvious one is as interest rates go up, cash flow goes down. So more specifically, what I'm trying to get at is how should investors be thinking in this market in order to set themselves up for, let's say, 5 years down the line, and let's just say interest rates do start to rise in 2 to 3 years, and they go up incrementally over a couple of years, and they start to go back up to like 5, 6, 7%. How should investors be thinking about their investment strategy now on that basis? Because I think a lot of the mistakes that a lot of people are making is they think short term when they should be thinking long term.
Well, I mean, one thing they could consider is locking in their interest rates, fixing their interest rates, because, I mean, one thing we know for sure, they're not going to go any lower. They can't go any lower. The official interest rates, the next step down is 0, and that's not going to happen. So why not fix your interest rates for a period of time? So you know that what your interest rate's going to be for the next 3 or 4 or 5 years. That's one thing you could consider. Another is that, like, if you're buying now and you're, say, borrowing at 2%-ish, and you've bought in a good regional centre and you're getting a 5% rental return, so you've got probably a positive cash flow situation. 3 years from now, interest rates might go up, but your rent will have gone up by now, by more in the intervening period, because we have this situation where, except for inner Sydney, inner Melbourne, inner Brisbane, vacancy rates are incredibly low everywhere. It's a crisis. There's a shortage pretty much everywhere, and there's great impetus for rents to rise, and people are experiencing that right now. Rents are rising in many places faster than prices are, and that's unusual. So 3 years from now, when we might have some interest rate rises, the gap between the current interest rate they're paying and the rental yield they're getting will have increased. So there's a compensating factor built in there. So I think if people think in those terms, they should be comfortable. And bear in mind also that the bank that gives them a loan right now, they're not going to assess them at 2%. They'll assess them at 4 or 5%. And so they've already been assessed as being able to accommodate future interest rate rises. Otherwise, they wouldn't get the loan.